On March 15, 2023, in New York City, a critical incident unfolded that would resonate throughout global financial markets. The main actor in this unfolding drama was a finance technology firm, Algorithmic Solutions, known for its advanced artificial intelligence model designed to enhance trading algorithms for investment firms. This model integrated multiple data feeds and utilized machine learning to refine real-time trading strategies. Shortly before the incident, Algorithmic deployed an updated version of their AI system, which included modified tuning parameters intended to improve performance. However, a significant oversight occurred during this update process. The tuning adjustments were based on historical performance metrics without adequate testing against live market conditions. This misconfiguration introduced an unconsidered variable. The model became overly sensitive to minute fluctuations in market data. The AI's learning algorithm began interpreting normal market volatility as definitive trends, leading to flawed decision-making processes. This technical failure was compounded by a lack of sufficient internal controls and oversight. Documentation outlining the necessary testing and validation procedures for updates was incomplete, creating a gap in organizational processes. Furthermore, the platform's logging mechanisms failed to capture vital analytical feedback regarding its performance under live conditions. As a result, there was no early warning about the model's deviation from expected behavior. By March 16th, the day after the update was deployed, the initial measurable impact became evident. Investment firms using Algorithmic's AI began reporting unusual trading activities. For instance, a notable firm, Apex Investments, which managed approximately $15 billion in assets, experienced a sudden spike in sell orders triggered by the AI's distorted readings. During a crucial trading window that day, Apex's system executed trades that sold off approximately 2 million shares of the leading S&P 500 companies, contributing to a significant market dip. Within hours, the overall market dropped by 2.5%. Erasing around $300 billion in market value within the first day of trading alone. Internally, Algorithmic's team started responding to the alarming patterns observed in the market. Confusion set in as analysts reviewed the sudden market shifts. Emails circulated among team members attempting to dissect the issue. An internal incident channel opened, allowing engineers to report real-time findings and discuss potential fixes. Initial assumptions focused on unexpected market volatility rather than the AI model's operational integrity. One team member suggested reverting to the previous version of the AI software, yet others argued that doing so might fail to explain the inconsistencies in trade execution. This disagreement, paired with a lack of clear leadership, stymied any rapid resolution. Externally, the ramifications were immediately felt by users and clients. Traders began sharing their experiences in various online forums. Social media platforms erupted with complaints about unusual trading behaviors and difficulties in execution. Meanwhile, algorithmic trading monitoring systems triggered alerts to investment firms, indicating abnormal trading patterns consistent with erratic algorithms. Minor media mentions started appearing, highlighting concerns about potential algorithmic biases and lapses in oversight. As March progressed, Algorithmic's inability to ascertain the root cause of the issue led to increased anxiety within the financial community. Major investment firms began pulling back from utilizing the AI-driven trading models, causing a ripple effect throughout the market. Algorithmic's executives scrambled to contain the fallout of this unforeseen incident, attempting to communicate with their clients and mitigate the strain on their reputation. Despite these efforts, the situation only escalated. On March 20th, the flawed AI model continued to impact multiple trading platforms linked to Algorithmic, creating alarm within the financial infrastructure. More investment firms reported suspicious behavior, with claims that the model's trades were misinterpreting basic market signals. A string of sell-offs began to correlate, leading to broader market instability. This growing uncertainty led to the first calls for regulatory review. Pressure mounted from regulatory bodies as well as from the financial media to investigate the vulnerability of AI systems in critical trading environments. Internal reactions at Algorithmic began shifting from confusion to urgency, prompting the formation of a dedicated task force aimed at understanding the cascading failures of their AI model and mitigating further disruptions. All the while, economic indicators began to reflect the mounting crisis, with analysts predicting the potential for a liquidity crunch that could cripple additional sectors. As April approached, alarming thresholds had been reached. The interplay between Algorithmic's simplistic tuning error and the complexity of the financial systems led to interactions that were entirely unforeseen. While Algorithmic grappled with its malfunctioning AI model, external pressures intensified, foreshadowing a much larger crisis. The stability of not just individual firms, but entire markets was now jeopardized. Signs of this entangled crisis hinted at a systemic collapse, awaiting further unraveling as the consequences unfolded in the coming weeks. On April 2nd, amid increasing market turbulence, Algorithmic faced mounting pressure as more firms reported either financial losses or technical failures directly linked to their AI systems. Apex Investments and other firms that had relied heavily on the flawed algorithms revealed they collectively suffered losses exceeding $500 million due to triggered sell orders. As news broke of these substantial financial impacts, public confidence in algorithmic trading began to deteriorate significantly, sparking discussions amongst stakeholders about potential policy reforms. The escalation prompted rapid actions from regulatory agencies. On April 5th, the Securities and Exchange Commission, SEC, announced they would commence an inquiry into the malfunctioning AI systems, focusing on Algorithmic's role and the algorithmic trading landscape as a whole. Their investigation sought to understand how such errors could remain unaddressed during deployment phases, and what measures could be taken to prevent future occurrences. As the investigation unfolded, the chaotic trading environment continued to detonate further volatility. The markets plunged again on April 10th, with the S&P 500 experiencing its largest single-day drop since the 2008 financial crisis, bleeding an estimated $1.5 trillion in market value overnight. The total losses were now approaching $2 trillion, with thousands of investors affected globally. Algorithmic's stock price plummeted by 40%, wiping out investor confidence and severely harming its market standing. Compounding matters, a report surfaced on social media detailing potential insider errors and miscommunications relating to the AI's tuning update, suggesting that critical warnings from junior analysts had been ignored. On April 15th, as the threat of a liquidity crisis loomed larger, Algorithmic took the extraordinary step of communicating a product recall of the affected AI model. The announcement included an immediate halt of all trading algorithms linked to the faulty software pending a thorough audit. In their effort to control the damage, Algorithmic offered financial compensation to affected trading firms and promised a detailed investigation into operational practices. particularly regarding their deployment processes and compliance checks. However, efforts to salvage Algorav's reputation faced heavy scrutiny. Financial analysts and the press intensified their focus, with journalists uncovering internal chat logs that indicated repeated concerns raised by employees regarding the AII's changes before the launch were downplayed or disregarded. This revelation intensified the pressure from both the public and regulatory bodies for stricter governance on the AI technologies employed in high-stakes trading environments. As April transitioned into May, consequences continued to accumulate. The SEC officially launched its public inquiry on April 30th, issuing subpoenas to Algorav for comprehensive records of all communications and incident reports surrounding the incident. The public's mistrust led to a sharp decline in users across several platforms reliant on algorithmic trading, prompting several firms to promptly review their internal systems and pull back from AI investments altogether. Throughout May and June, legal actions multiplied as investment firms collectively sought compensation for losses. Apex Investments declared a lawsuit against Algorav, alleging negligence and failure to provide a reliable tool that fundamentally violated fiduciary duties. The news of potential lawsuits ignited broader fear across the investment community, leading to several prominent brokers reconsidering their ties to algorithmic trading in favor of more stable, human-led approaches. By July, Algorav struggled under the weight of heightened scrutiny, declining influence, and ongoing lawsuits. They faced a potentially crushing combination of shareholder losses, regulatory fines, and the exodus of key talent, many of whom left for competitors unharmed by the crisis. The company's assets dwindled, pushing them closer to insolvency. Notably, the significant financial manipulability concerns from investors led to clients seeking third-party audits and permanent changes in their algorithmic governance practices. By the end of August 2023, Algorav had declared bankruptcy after failing to secure sufficient funding or partnerships to stabilize its existing operations. The court proceedings initiated bankruptcy protection, while ongoing investigations by the SEC continued to uncover regulatory oversights and compliance failures that might reshape future AI policies in the financial sector. In the aftermath, regulatory bodies introduced tighter compliance standards for AI deployment within financial systems, emphasizing the need for rigorous testing and oversight before innovations could reach market readiness. Legal ramifications loomed large, with authorities pursuing charges against several former executives connected to Algorav's management during the crisis. As of October 2023, Algorav's operations were permanently shut down, marking a definitive shift in how financial institutions approached AI governance. Investment firms and analysts reevaluated their use of automated trading platforms, emphasizing transparency and accountability as the cornerstone of their futures. The incident served as a catalyst for industry-wide changes in regulatory frameworks, ensuring that reliance on automated systems would henceforth be governed more stringently to avoid repeating similar crises. The lasting impact of the algorithmic-induced turmoil stands as a stark reminder of the vulnerabilities such advanced technologies can introduce into complex systems.